Hey everybody, JJ here, back again with a Wednesday of Zoom networking. And, you know, I'm always excited about my calls, but I think this one is the gold nugget of the whole year for you guys. This topic is going to be extremely valuable for every single one of you. Our guest speaker is a gentleman that's highly regarded and respected in his field of expertise. His field of expertise is one that you definitely want to hear about. It's the field of 1031 exchanges. I'd like to introduce my good friend, Mr. John Mangham. John, how are you?
Thank you, JJ. Always a pleasure to join you on the video, and I look forward to joining you in person very soon.
Yeah, it's going to be in June, June of 25 here in Southern California. Hey, for those that don't know you, where in the country are you located?
So I'm in Atlanta, Georgia. I've lived here 50 plus years. Along with being a 1031 guy, I'm also a real estate investor. So I do a little bit of what you do and what y'all do. There you go, Southern, y'all. It's just the way it is. But I've got a few rental houses, and basically, I'm in the game. I appreciate what everybody does because I do it too in my own little way. Um, my expertise is 1031. That's what we're here to talk about today. But I walk and talk, as many of y'all do, in the residential rental real estate market and a little bit in the commercial. So, JJ, thank you for having me on the program today.
I am so thrilled to have you here. Let me tell you, I constantly hearing about 1031 exchange, 1031 exchange. We were talking before we started the recording here today. We actually started talking about the word tax, right? And you had a comment on that I wanted you to kind of throw in there. But how does that play into this?
So, everybody's got a fear of something, fear of heights, fear of spiders, fear of snakes, but we all have this either fear or dislike of the tax man, right? And if we can get a leg up on the tax consequences of a transaction or the taxes that we pay as we go through our career, whether it's property tax, income tax, or any other kind, in our world, it's capital gains tax. If we can get a little advantage or a little bit of workable knowledge that puts us in a stronger position, you go forward with more confidence. And today we're going to break down 1031 in a way that you'll go forward with confidence in your real estate transactions. So my goal, in a nutshell, is to have y'all walking and talking 1031 exchanges.
I'm so excited. Hey, let me ask you, we got some people on the call that are brand new investors, and as people will be watching this interview weeks and months down the line on YouTube, we'll have some new people watching as well as experienced people. For those that are new to real estate, what is a 1031 exchange? We hear that all the time. What is a 1031 exchange?
So let's approach 1031 from a couple of angles. First of all, 1031 is a section of the IRS tax code. It exists to allow you to defer the gain on the sale of a property held for investment. For our conversation, we'll talk in terms of a rental house. It could be raw land, it could be commercial property, it could be a variety of things. But over 100 years ago, 1913, when the tax code came out, they basically said real estate is illiquid. So if you get rid of a piece of real estate and you acquire a replacement in a structured transaction, you can defer the gain. And because of the illiquidity, they essentially created this provision that said, as long as you maintain a continuity of investment. So if I have a property today worth 500, I get rid of it, I get a replacement for 500 again, and we'll talk about the process. But if you maintain the investment, then you don't have to pay the tax today. If you cash out of the investment, then the taxes come due. So if you sell something for a profit, you're going to pay capital gains tax. And today we're going to sort of decipher what 1031 is all about. It covers the world of real estate investors, not primary residents, not builders, developers, dealer property, but real estate investors, which your audience, by and large, is squarely in that camp.
Yeah, definitely. And I'm glad you clarified that because I was thinking, I own commercial property. I own some residential rentals. And yet have a personal residence I have in California here that, California has high property taxes. And do you want to stay here forever? I could probably sell that and buy a huge place in Tennessee and get 40 acres in a mule. you know. But I'm glad you clarified that it doesn't really pertain. Well, it might pertain to real estate, but not to your primary residence. Is that correct?
That's correct. Your primary residence lives under its own code section. If you sell your primary residence and you met the rules of living there for at least 2 years, owning it for at least 2 years, you can exclude the gain, some of the gain on the sale, up to 250,000 if you're single, 500 if you've got two owners, married, joint, that kind of thing. Which that exclusion works pretty well in many parts of the country. All my friends in California say, well, I bought the smallest house I could find. It's 800 square feet. It was $1 million, and now I'm selling it for 2 million. What's this 250 exclusion about? It doesn't help me much. And that's the nature of high-end, expensive real estate in some parts of the country. But the primary residence has its own rule or rules, which give you an exclusion. Property held for investment. And again, I'll keep it relatively simple. We'll talk rental real estate or commercial real estate, could be rental real estate or raw land. When you sell investment property, you have the opportunity to structure the sale as a 1031 exchange. And when we get into this a little further, we're going to break this down into the essential elements. I'm going to give you the whole program. JJ, you're going to kill me, but I'm going to do the whole program in 10 seconds. I'll give you the elevator speech and it's the whole thing. Now, it doesn't give you the strategies, but we're going to go from the elevator speech to the strategies.
Okay.
So, JJ, I'm a speaker. I work in the 1031 world. I enjoy talking about it and breaking it down in citizen speak as opposed to technical CPA speak, because that gets dry and boring.
Yeah.
I'm at a conference and you get on the elevator with me. I don't know you, but you see my badge and I've got a ribbon. It says speaker. And you say, oh, Mr. Mangham, 1031, what's that? Just as you're getting your family attuned to social media and putting themselves out there, if I get on the elevator with you and you approach me and say, oh, 1031, what's that? Now we're at the conference. We got on the second floor. We're going down to the first floor. How long do we have to engage in a dialogue?
60 seconds.
Oh, 10 seconds, maybe. This is a fast elevator. How can I get you interested in my world without telling you all about myself, but rather telling you something that would be interesting to you? Do you think I can explain 1031 exchanges to you in 10 seconds and make you ask me for my business card? And of course,
the answer is yes.
You know that's a leading question. So we get on the elevator and you say, Mr. Mangham, I see you're a speaker, 1031, it's on my badge. What's that? Start the stopwatch. JJ, 1031 is about tax savings. Number one, tax savings. 2 words, tax savings. I'm going to give this to you in 4 2-word phrases. Tax savings, investment property, time period, equal or greater value. I know that's more than 2 words. And you're going to say, investment property, I've got a friend down the street selling a duplex like that. Yes, that would be an investment property where you could save the taxes when you sell the property. You've got a time period to work with, and you've got to acquire something for equal or greater value. The bell goes ding. We get off the elevator, and you turn to me and say, could I give your card to my friend who's selling his duplex? You just got something of value because you got a framework for 1031. It's simple. Tax savings, investment property, time period, equal or greater. I got something of value because I gave somebody a card, not because I pushed it on them, but because they asked for it. And if you can build the relationship, I'm going to go back to your Facebook comments, work on the relationship, chase the relationship. If I can plant a seed or a hook and you ask for my card, then if I should ever reach back out to you, or if you reach out to me, hey, I met you at that conference. I got your card about the 1031. Absolutely. How can I help you? Well, I'm selling this rental house. Can we talk about it? And that's the beginning of the conversation that ultimately leads to the numbers, the tax calculation, the potential savings, and then the mechanics of the 1031 exchange. So when I teach a class or when I do a program like this, I start with, let's keep it simple. Let's get everybody engaged and everybody can hold on to this. I've had people write these 2-word phrases on the back of a business card. I'd like to buy your property. If you're selling it and you have a gain, I can put you in touch with a guy that can talk about 1031 exchange. What's that? And JJ is going to say, I remember what that is. That guy on the elevator told me. It's number one, tax savings. Number two, investment property. If you hear like kind exchange, 1031 exchange, tax deferred exchange, like kind, that's what we're talking about. Tax savings, investment property, done in a time period, we'll break that down, equal or greater value. And if you can string together the same 4 phrases in a conversation with somebody, with a citizen, as I like to say, not a professional, not a CPA, not an attorney, not somebody who does this all the time, then you can engage in the dialogue about what a 1031 is. And that just gives us a framework. It's like building a house. You have to put the frame up. Then you put the doors and windows in, you put the roof on, you put the flooring and the cabinets in. And lo and behold, we're building a real estate analogy on a tax topic. And we're going to take that framework, talk about those components, which are the essential elements, back to the title of today's program that you asked me for. We're going to cover the essential elements in a way that people will understand what they are, and then we're going to talk about how to use them, and then layer in some strategies in your day-to-day business. So I'm excited to be here, and I appreciate you bringing me on board today.
I am so excited. Yeah. So we have tax savings, investment property, time period, greater or equal value.
So JJ, if the elevator door dings and I keel over and you get out, I want you to grab my badge just in case somebody has a 1031 question, because you now are walking and talking 1031. And if the call ended right now, you've got the nuggets. You've got the 4 essential elements. Now, there's a lot more to it, of course. There's all this technical stuff behind it. But once we have this inner understanding, it lets us move forward with more confidence in our real estate transactions. And that's why I build it from the basics, and then we layer, and then we layer, and we grow our business. And when we sell our rental house that we bought for 200 and we're selling it for 800, to use an example, with a 600 profit and the capital gains tax, federal at 20%, that's $120,000 on the profit.
Man,
you've got state tax, which runs from 0 in places like Florida, Texas, and Tennessee to 13% in places like, right there where you are, California. You add another 13% on the 600, you're over $200,000 in capital gains tax. And you know what you thought when you went to sell that rental house for $800,000? You know what you thought was going to be the most expensive part of your transaction, particularly if you're working with a real estate agent? The commission. And we all have a sense of what it costs to sell property. There's always friction in a transaction, costs of the sale. But the last thing you want is that bus to come up behind you and run you over next April when you do your tax return, and you find out you got $150,000, $200,000 capital gains tax liability. You thought you'd struck it big and you did something with the money, but the IRS has a bigger stick than any other single cost in the transaction. And it's important you don't have to be tax experts, but it's important to have an understanding of what the IRS does, how they operate. And so when you sell that rental house, they collect capital gains tax. And most states in this country collect a state level capital gains tax. So big round numbers, if you use 25, 28% for a combined tax rate on a $600,000 gain, that's over $150,000 in taxes. So if I can help you save $150,000 on the sale of an $800,000 property, do I have your attention?
Oh, yeah.
Tax savings. We just covered the first essential element, and we built an example around it. Now we're off the elevator and we're walking over to the bar, and maybe we're going to get a drink, and you're going to say, can you tell me more? Well, JJ, are you sure you want to have a tax conversation on a Wednesday afternoon? And of course, the answer is yes. So number one, tax savings. Federal capital gains tax, state tax. This is a topic that I can talk about in all 50 states because it's federal tax law. 1031 is the section number of the IRS code. Supporting that, you've got pages, 70, 80, 90 pages of regulations. You've got private letter rulings, technical advice memorandums. You've got court cases. I'm the guy that reads court cases for fun. It'll put you to sleep, I guarantee you. But the objective is to put it to use in your business. Mm-hmm. So this house that you bought back in the downturn, let's say, and you got a nice profit, but you're moving from Chicago to California and you're going to sell the house in the place where you used to be. Can you sell in Chicago and buy a replacement in California? The answer is yes. Structured properly, the answer to most questions will be yes. But we need to have a basic understanding of 1031 exchange, tax savings, investment property, anywhere in the country. So
you go from one state to another. You don't have to be only in the state where the original property is, is it correct?
Anywhere in the country. You can do this in all 50 states. In fact, we're set up to support the transaction. We serve as a facilitator in these transactions because when you're selling in one location and you're buying in a replacement property in a different location, even if it's two neighborhoods in Atlanta, where I am, you've got to be able to put these two transactions together with an appropriate documentation package. At the end of the day, that's the role that I serve in this. But to be part of that transaction, people need to have some confidence that I know how to help them get from here to there. I'm reversed on the screen, I should say, from here to there, left to right. But the idea is you're selling a property, you're going to have a continuity of investment, a continuation of your ownership, and you're going to acquire a replacement property of equal or greater value to save $150,000 or potentially more in capital gains tax. Before you ever go to market, before you ever put your property on the market for sale, you need to have a reasonable sense of what the tax liability looks like. Okay. You need to have either talked to your CPA, tax preparer, or called somebody in the 1031 business. Like JJ, you and I went through an example when we talked, it was a couple of weeks ago. I said, if you had a house that you bought for 200 and sold for 800, you got a gain of 600, you got some depreciation recapture. Whew, depreciation recapture. My eyes are about to glaze over. Do we have to talk technical? No, we don't. We just need to know that the tax liability is going to be 150 to 160. What if it's 145? It's still significant. What if it's 165? It's still significant. The savings are there if you buy a replacement for 800 or greater. And you say, well, I'm going to go to Tennessee where houses cost less. That's fine. You can do that. But I don't want to buy an $800,000 house in Tennessee. That's a big house with 40 acres. Well, why don't you buy 2 houses or 3 houses? You can do that. How would you like to buy 3 replacements for that $800,000 sale? And the answer, of course, is yes, you can do that. So at 1031, again, tax savings, I'm staying with my framework, tax savings, investment property. To give you the dry and boring paragraph, any real property held for productive use in a trade or business can be exchanged for any other real property to be held for productive use in a trade or business anywhere in the country. So that means you could sell a piece of land and you could buy rental houses. You could sell a commercial building and you could buy self-storage. You could buy anything because in the crazy world of the Internal Revenue Service, the term like kind doesn't mean same kind. I still get questions. I've been teaching this for 30 years. People say, I'm selling land, I'm selling a farm, and I understand I have to buy like kind, I have to buy another farm. No, ma'am, that's not exactly right. In the world of the IRS, like kind refers to held for investment. And investment, the 2 basic premises that we all follow when we go into investment real estate, appreciation and cash flow. Cash flow like a rental house. Appreciation, why did you buy that piece of land? It's going to go up in value. The city is growing, it's moving out to my land. One day I'll be able to sell it for a nice profit. So any real property held for investment can be exchanged for any other real property to be held for investment. Number 2, so we've got tax savings on investment property. All that because you bumped into me on the elevator. Can you believe that?
Crazy.
So I know our goal today, my goal for the family here today, for your group, is to have them walking and talking 1031 with some concrete examples. So you sell a rental house that went up in value because you bought it during the downturn. You buy two replacements. 5, 7 years from now, you sell one of those, it's grown again. You buy two more replacements. Building your wealth, building your portfolio, using the IRS's money. What's not to like about that?
Jerome Johnson, you are on with John Mangham himself. What's your question?
Thank you, JJ. Hey, John, I have a question about how the property is held. Like, for example, if you have a property held in a trust and you wanted to 1031 exchange it into LLC, is that problematic?
So, Jerome, thanks for the question. Think of it this way. Whoever is the taxpayer, whoever is the tax-paying entity, for us personally, we think of a 1040. If you have a partnership or an LLC with multiple members, you file a 1065 tax return. It has its own taxpayer ID number. Whoever is the owner of the property that's being sold, and I'm going to refer to that as the relinquished property. That's the one we're going to let go of. Whoever is the owner of the relinquished property must be the person or the entity that acquires the replacement. Now, there are some subtleties and there's one little exception. So at the basic level, if I own a rental house and I sell it, then I would acquire the replacement in my own name. If the three of us who are on the screen right now were together in an LLC, and we're going to call it the JJ Rental House LLC, and we owned a rental house in the LLC, and we were all members of the LLC, we filed a 1065 tax return. We bought it for 200, we're selling it for 800. We all got together and said, let's keep going. We're doing well. We're doing great. The LLC would sell the property. Whoever's the manager of the LLC will sign the closing statement, sign the documents, and the LLC would acquire the replacement property. Now, there's one little category that sometimes opens up opportunity. If you own property individually or in a single member LLC, a single member LLC for IRS purposes is considered a disregarded entity. It reports up through your personal 1040 tax return. So the results of operations on that rental house, even though it's in a single member LLC, report up through Jerome's 1040. When you sell that, you could buy a replacement in the same LLC, you could buy a replacement in Jerome individually, or you could create a new LLC, a new single member LLC for the replacement property. So as we layer on our examples, and then we say, but I've got it in a trust. Well, is this a land trust, like an Illinois land trust, an Illinois type land trust? If so, that's also a disregarded entity. So whoever that has the beneficial interest in the Illinois land trust can sell the property, do the 1031 exchange, and acquire the replacement, either in the same land trust or in their individual name or in a single member LLC. So if you want to analyze the trust document, we could go to a breakout session, come back in about 6 hours. Oh, wait a minute, we don't have 6 hours. There are a lot of ways that trusts get put together. Is it a grantor trust? Is it a revocable trust? Is it an irrevocable trust? And you've got to go to the trust document to determine what's going on with the owner that owns the property in a trust. If we get involved in an exchange and there is a trust that's an owner, we need a copy of the trust document. We need to understand who the beneficial interest goes to. We need to understand how the trust reports its tax return. And good gosh, we've got a bunch of people on this call who are saying, what's this trust stuff? And I don't have a trust. And what's the third essential element, John? So, Jerome, the answer is probably yes, but the trust document is going to govern. So how's that for an answer that's a non-answer?
Great answer. Thank you. I think that helped me out a lot. Thanks.
Good.
Jerome, thank you so much. John, on that same note, I have a trust, and I have LLCs. And let me revisit that question for the sake of one person owning property in a trust. And then, of course, if we want to make it a rental property, let's say I own a commercial building in my trust. All my rental properties are in LLCs to protect myself. If I have, let's say I have multiple properties owned by my trust that are a second home, which is a rental, is in my trust, and I want to sell that second home, buy another property, but that second property will be in an LLC. Again, owned purely by me, and the trust is 100% mine. The LLC is going to be 100% mine. Uh, what you just described is then that's not an issue. It can go from the trust that's mine into an LLC that's mine. And of course, I'm simplifying it by not adding a second or third person to the situation here.
If you have the 100% beneficial interest in the trust, and if the trust, the operations in the trust, the rental income from that property reports up through your personal tax return, your 1040, and you've got these other 2 or 3 LLCs or more, but some LLCs, and they are single member LLCs, what happens here is you've got, we're talking about real estate and real property and law and taxes, and you put these properties in LLCs for protection, but that's civil law. So that if somebody falls down on the property, breaks their leg, and they sue the owner of the LLC or the trust, maybe they win. Maybe it's a bad situation. They win. They take the property from the LLC, but they can't come through the LLC to you personally, and they can't come get properties inside the other LLCs. That's all civil law. Tax law, IRS tax law. So if it were perfect, it would mesh like this. But if you've got civil law and you've got tax law, it kind of meshes like this, where you've got these hanging pieces where there's a disconnect. And for tax law, all those LLCs are considered virtually your alter ego. So you could sell a property from the trust to an outside third party, and you could then go down the road and acquire a replacement in one of your other LLCs. From my perspective in processing the transaction, what we would ask is we need a copy of the trust document. We need a copy of the LLC operating agreement that it's going into. We need for you to send us an email that say you're the 100% beneficial interest in both. And then you're going to be good to go. And your CPA or your tax preparer, when they file the Form 8824 at the end of the year that reports the results of the 1031 exchange itself, it's all going to report up through your personal tax ID number. For tax purposes, you're completely fine. For protection purposes, you're using these different LLCs out here to keep them separate from each other and to keep privacy so the world doesn't know. And guys, on your different LLCs, do you have different registered agents? Do you use different mailing addresses for those? Or is it real easy to find you because you're the same registered agent for all your LLCs? We could go down that path, but that's not today's topic. I use multiple LLCs. I put several rental houses in an LLC at a time. I'm a big believer in good, strong liability insurance. So the slip and fall accident gets battled by the insurance company's attorney. Property casualty, so the tree that comes through the house, the insurance company pays. And then you put an umbrella policy over the whole thing. For $500, you can get $1 million or $2 million umbrella policy, or for $500 to $1 million. So your first line of defense is not the cloak of the LLC. It's not just wrapping yourself up where you're hidden, because you can be found. Your first line of defense is still the insurance company's attorney. No matter whether it's in an LLC or a trust or your name individually, you still want a good, strong insurance policy behind what you have, because the right attorney can pierce that LLC, can still drag you into a lawsuit. And then what? You're going to hire an attorney, or you're going to have your insurance company's attorney go represent you because you've got a good insurance policy. So these are sort of not school of hard knocks, but I've been around this world. You see, I've got the requisite gray hair. The reason I keep it short, every time I get a haircut, the more you cut off, the younger I look, because there's less gray on my head, right? Anyway, so the answer, JJ, back to can you do it in an LLC? The answer is yes. If we have a multi-member LLC, that's going to get a little more complicated. If we have a multi-member LLC, I may as well address the question that's on people's minds. You and me and Jerome had that house in an LLC. We bought it for $200. We're going to sell it for $800. But you moved across the country, or I did. Can I take my share and do a 1031 exchange? You cannot exchange a membership interest in an LLC or a partnership interest in a partnership. You must exchange a direct interest in real property. Think of it as what's on the deed. So what we would have to do is drop the asset, drop the house out of the partnership or LLC into the three members or co-owners. Then each one of us could either choose to take 1/3 of the cash at the sale or to do a 1031 exchange on our portion. Jerome can take his $266,000 and buy something where he lives. John can take his, and JJ can take the cash and buy that red sports car and drive across the country. You'll pay tax on your share. Mm-hmm. So there are ways to manage the process. And when we talk 1031, and we've got the essential elements, we've got the basic framework, tax savings, investment property. We're going to go to time period. It's important to start having the conversations about strategy when you start thinking about putting the property on the market. I talk to people every day, and they're going to be putting a property on the market in a month or two. We walk through the basics of 1031 and what they can do. I don't hear from them again for 2 months, 3 months. Next thing I know, they've got a contract, they're selling the property. Now it's time to engage me formally to serve as the facilitator, to set up the front end of the exchange, to link it to the back end of the exchange. But if I can help you focus on what to buy for replacement property, it's the Stephen Covey principle. Start with the end in mind. If you're building your portfolio and you know what you want are 3-bedroom, 2-bath, brick ranch rental houses for $250,000, $300,000. I don't know what the prices are in everybody's communities. When you sell that commercial property, JJ, that probably needs a little work, it's been around for a while, you're ready to be done with it, and you sell it for 800 or 1.8, whatever the number is, and you buy a bunch of little houses for the cash flow, because you reach a point in life where the cash flow is what's important. You start with the end in mind, then you work backwards. When you get ready to put the property on the market and you say, Mangham had a great example, $150,000 tax liability, but I'm selling for more than that. My tax is even worse. That will get you laser focused on finding that replacement property. Whew. You can tell I enjoy this.
I love this. I'm loving this. Let me tell you. So let me ask you, you have a property. We want to look out there. We want to get a feel for maybe what the ramifications might be if we sell that. Once we sell it, I'll get into time period. How much time do we have? Do we have to do it right away? Is it expire in a week, a month, 6 months? Can we wait a year and a half?
Just lobbing them over, right? Here we are on the elevator. We got on the elevator. You said, speaker 1031, what's that? And I told you, tax savings, investment property. We are 5 seconds on the way to our 10-second descent. And the third essential element is time period. JJ, from the time we close on the sale of that rental house, I'll continue with this example of an $800,000 sale. From the day we close and we transfer the ownership, the date on the deed, two clocks start running. There's an identification clock. You've got 45 days to identify or to pick out your replacement property or properties. And if you ever want to feel time pressure, start a 1031 exchange. 45 days goes by, how fast? Just like that.
Lickety split.
Don't tell me that it's going to be raining this weekend. You don't want to go look at real estate. Don't tell me you got to go out of town next week. You got $150,000 tax liability. Go shopping. But if you talk to me 6 weeks ago, 8 weeks ago, I will tell you one of the most important things for you to do. I got all the paperwork. I got all the background. Been doing this for a long time. The single most important thing for you to do, JJ, is to do what they do the day after Thanksgiving. Get up early, go stand in line, and go shopping. Go shopping for replacement property. Go to Google, go to the internet, go to Zillow, go to wherever you go to peruse properties. Get a feel for what's out there. Go to Tennessee if that's where you're looking. Get a sense of what you would buy. You can make offers if you see something really good. But with 45 days to identify, and identification means you send in a designation letter where you say, Dear Craft 1031, Dear Mangham, I identify the following property or properties. And there's some rules associated with that, but the time constraint is what's critical. So if there's any fire I can light under y'all, all of y'all who are on the program this evening, is to go shopping. When you start thinking about selling your rental house, you get your 1031 framework figured out, you get your tax liability figured out, then you start perusing the market and you go tour. If you're going to buy somewhere outside of your area, you got to go this coming weekend, go drive around, go in the houses, or go look at what you're going to look at. From the day the clock starts running, the day of closing, you have 45 days to identify, plus an additional 135 for a total of 180. So the time periods we hear in 1031 exchange regularly, 45 and 180, 45 and 180, but 45 is a subset of 180. So you've got 45 to identify, a total of 180 days to close. The practical issue, the practical consideration of that 45-day designation period is that when you start shopping, if you find a really good deal, you can't just put that address on a piece of paper and think it's going to be there next week.
No.
Because somebody else is going to come along this weekend and buy it out from under you. So you need to go ahead and write the contract. In my world, I see 1031 exchanges start and finish generally in 30 to 60 days. Not always. Sometimes they stretch longer. Sometimes got, a 3 or 4 month closing down the road. But it's a more compressed time period, not because you have 180 to work with. It's because you have 45 to identify and to designate the replacement property. So the numbers that are burned into my brain, and when we're on the elevator again, I like to joke, I like to keep it lighthearted. Tax savings, investment property, time period, and you say, how long? 45 and 180. Don't forget those dates. People call me and they say, so I've got 60 days. No, ma'am, you've got 45 days. And I've got 6 months. There's a court case we quote. Taxpayers started an exchange on June 25th, completed the replacement property on December 25th. What's wrong with that puzzle? July, August, October, all have 31 days. He took 183 days to complete his exchange because he went 6 months. It's not 6 months. It's 180 days.
Mm-hmm.
And the tax court judge said, there's nothing ambiguous about 180 days. It's not open to interpretation.
Yep.
It's 180 days. Overruled, exchange denied, taxes due, plus penalties, plus interest.
Wow.
So 45 and 180, and you just took the third essential element and put it out there for everybody.
His name is John Neuendorfer. John, you're on with John Mangham. We got the two Johns here.
Hey, John.
John Neuendorfer,
Hi.
what's your question?
My question is, I'm involved in a couple syndications for apartments. So when those refinance or sell, does a 1031 exchange apply to syndications?
Good question. So when you talk about a syndication with apartments, sponsor, promoter, general partner, put a deal together. And I'll just make an easy example. One guy says, I found the property. We're going to buy these apartments for $1 million. I've got to go out and raise some capital. I'm going to put 100,000 in, and I'm going to go get 9 other people to put 100,000 each. And I'm just constructing a simple framework. And that's kind of what a syndication looks like, where you take a property and you syndicate it out, you bring multiple partners in. That property is probably held in an LLC, maybe a partnership, but these days it's probably an LLC. We bought it for $1 million. 5 years go down the road, it's worth $2 million. If you refinance the transaction, when you refinance a property, the proceeds that you take out of it do not create a tax liability. So the sponsor, whoever's running the deal, the syndicator, can take the proceeds and distribute them to everybody, and you get a chunk of your cash back. There is still a gain built up in the property. The apartments that are worth in year 5, $2 million that you purchased for $1 million are carrying $1 million gain, even if you got your cash back out of it due to a refinance. And let me build the example. Let me continue. Let's say we go to year 10, and now the apartments are worth $3 million, and he says it's time to sell. When you have a sale, that's the time to consider a 1031 exchange. And on the surface, it looks like you've got a $2 million gain, but you've had 10 years of depreciation deductions. And on a multifamily housing project, depending on how they set it up, they're either going to depreciate it over 39 years or 27 and a half years because they define it as residential. But you've taken a good chunk of the $1 million in depreciation. So when you do the tax calculation, you got tax on the profit of $2 million, 20% federal. I use 6% for state because it's an average across the country. 26% of 2 million is over $500,000 in combined federal and state capital gains tax, plus tax on the depreciation recapture. And I won't go into that example right this second. So, John, when you ask about, I'm in a syndication, I'm involved with some apartments. When we go to refinance it, what happens? Nothing. However, the tax liability still sits in there. When we go to sell it, can we do a 1031 exchange? The answer is yes. And with a $500,000 capital gains tax liability, or probably more than 600 counting the depreciation recapture, you want to be talking to whoever's in charge of it. If it's you, you want to be talking to your partners or your co-owners saying, we're going to sell this $3 million apartment building and we can go buy replacement property. I've got these 3 good deals at $1 million a piece, or I've got a warehouse deal for $3 million, or whatever it may be. Remember, the entity that owns the property, in this case, the LLC, has to be the entity that does the exchange. But if 10 years have gone by and you've got 10 partners, what is the likelihood that somebody has either gotten married, divorced, I hate to say gone bankrupt, or maybe had a death in the family? Some partners don't want to go into the next deal. And so you've got to go through what's referred to as a drop and swap, where you take the asset, the $1 million original basis, $3 million value today, and drop fractional interests to each one of those co-owners to be held as tenants in common. And you record the deed that reflects that. And now each one of those co-owners can choose whether they want to take the cash or whether they want to set up their own exchange. Or if 5 or 6 of them want to stay together in the deal, you simply drop the 4 slices out to those people and they potentially take their cash and go on down the road. The time that the 1031 is applicable is when you're approaching the closing of a sale. When you're approaching thinking about a sale, that's the time to have the preliminary conversation to say, I'm going to be selling a $3 million property. What's my tax liability? Should I be thinking about a 1031? That's the first conversation I usually have with potential clients. Here's the lay of the land. Here's what you ought to think about. So fear not on the refinance, but if you're approaching a sale, you want to start with the end in mind and understand where you would go if you don't want to pay tax on your share of the profit.
Adolfo, you are on with John Mangham. What's your question?
Hey, John, my question is, I know you mentioned about insurance. Was wondering if you know exactly what specific insurance you're talking about.
So the first line of defense, if you have a problem, a big water leak or a tree goes through the roof or there's a fire, that's property casualty insurance. You want to make sure your limits on the houses that you've got make sense for what the values are today. I had a situation where somebody I know got caught. They bought houses during the downturn. In Atlanta, there was a neighborhood where you could buy houses for 30, 50, 70,000. They had $90,000 worth of coverage and the house was worth 200. A tree went through the house and the insurance company totaled it. They paid out the whole $90,000, but the house was worth over 200. So you've got to keep your insurance coverage limits reasonable for the value of the property, for casualties, for fires. The next level of insurance is liability insurance. That's where somebody comes on the property, they trip and fall, or somebody gets drunk and they fall over the balcony and they want to sue you. The liability insurance, in my mind, is prepaid legal coverage. And I've got some of the best attorneys in the world because they work for the insurance company. They battle these cases all the time. The person who fell on my property, tripped on the sidewalk or whatever, claims negligence, the insurance company attorney is going to fight that case because I've got good liability coverage. 300,000, 500,000, $1 million. You got to think about what coverage level makes sense for you. So property casualty, then liability. And then above that, once you've got a few assets, 2, 3 houses and some more stuff, your primary residence, you put an umbrella policy over that covers, let's say if you got $500,000 liability coverage on the property, then you buy $1 million policy, it covers the next 500. That's why they sell it for such a small amount. It only kicks in if there's a case and the tenant who had the slip and fall wins 600,000, your first coverage covers the 500, and then your umbrella covers the last 100. And after you've got 5 to 10 houses, you start looking at the umbrella needing to be a $2 million policy, and it's still only $1,000 or $1,200. So you monitor your coverages as you grow your portfolio and you grow your wealth. So I'm a believer in entities. I'm comfortable with land trusts, but good attorneys know how to attack the registered agent and the manager of those entities. You're going to get drawn into court. And don't rely on the fact that you've got this cloak around you called an LLC or a land trust. Don't rely on that to be all the defense you need. Keep your insurance at sensible levels also. There's a cost to that, but if you're going to be good in this game and if you're going to be successful in this game, you've got to be prepared to pay the freight along the way. And that's turnkey when the tenant moves out. It's insurance along the way. It's property taxes. It's all the stuff that's about real estate. In the long run, y'all know it's a get rich slow game, but I guarantee you'll get there if you stay focused on it.
Awesome, John. What is that the same as homeowners insurance?
Homeowners insurance is a combination of property casualty. Like again, let's say you had a hailstorm in your city and it damaged the roof. That's a property casualty. It's a casualty to the property. Your homeowners insurance would cover replacing the roof. If somebody slipped and fell on the property, your homeowners insurance has a liability component. You pay less for homeowners insurance because you're there on the property every day. On your rental properties, you pay more for the same value because you've got an outside third party living in your rental house. But the two broad categories, again, are property casualty is all together, and then liability. So homeowners covers both of those. If you look at your homeowners policy, you'll see limits for both of those coverages. So JJ, we've covered tax savings, investment property or like kind, time considerations, 45 and 180. And the last one, I wish I could say I'm saving the best for last, but I'm actually saving a fairly easy one for last. Equal or greater value, continuity of investment or continuity of ownership. If I'm selling that rental house we were using for our example earlier, selling it for $800,000, I've got to acquire replacement property for $800,000 to be totally tax deferred. Let's break that $800,000 down and say we bought the $200,000 property years ago. We had a $150,000 mortgage on it. Bought the property for $200,000. Let's say we had a mortgage for $150,000. We put $50,000 down when we acquired it. Over the 10 years we've owned it, the mortgage has gone from $150,000 down to $100,000. So when the property sells for $800,000, the old mortgage of $100,000 gets paid off and $700,000 goes into the exchange escrow account. Those funds are held in an escrow account, separated from any other exchange client, separated from our company funds. It's completely segregated. So people will say you've got to spend the cash, which in my example is $700,000, and you've got to replace the debt, which in the example on this one is $100,000. So you can take the $700,000 and you can buy a rental house over here for $250,000. You can buy a rental house over there for $250,000. You can buy the next one with whatever the cash is that's left over, another $200,000, and you'll get a mortgage for the difference. Now there's a fine point in here. People say spend the cash, replace the debt. Spend the cash, replace the debt. If you happen to have cash in your back pocket and you don't want to take on a new mortgage, you can replace the old debt with new cash. So you can buy $800,000 worth of replacement property with the $700,000 in the exchange escrow account plus $100,000 from your back pocket. So equal or greater, and then parentheses to be totally tax deferred. And one of the very first strategies that I want people to think about, if we're going to stay with my example, we're selling for $800,000, we've got to buy for $800,000. Don't go into Multilist or Zillow and say, show me everything in a certain zip code for $800,000 and above. Set your threshold below that. What happens if a killer deal came on the market last night for $775 and you were only looking at $800,000 and above? You'd miss it. It's better to do the killer deal for $775, complete your exchange. While it would be called a partial exchange, you sold for $700, you sold for $800, you bought for $775, you would only pay a little bit of tax on the $25. And in this example, if you pay $7,000 or $8,000 tax and you still save $160,000 in tax, you're still coming out to the good. The message here is it's better to do a killer deal. It's better to do a great deal and pay a little bit of tax than it is to overpay for a property. than it is to buy too much that you can't handle or take on a mortgage that's too big. So when we talk about the fourth essential element, and we say spend the cash and replace the debt, and we say equal or greater value, really the fine print is you can go below the threshold. Now, you may not want to go to 500,000 because you're paying tax on the differential of 300. But I always say look below the threshold, 25, 50, whatever the numbers are that make it comfortable for you. Because if you find that killer deal, it's going to make a difference in your real estate portfolio that will more than cover the $6,000 or $8,000 in taxes you wind up paying to the IRS. So, tax savings, investment property, time period, equal or greater value. And if we had your family, if we had your folks in front of us right now in a room, I would start my count, and I wouldn't finish those phrases. I would expect people in the room to fill in the blanks. And I would tell you, y'all are now walking and talking 1031. We did it in 10 seconds, and we've now done it in another, 45, 60 minutes. But the idea is walk into the 1031 transaction with some confidence. It's not scary if you break it down into its essential elements. It's not scary if you know a few strategies. Even if you've got partnerships and multiple owners and multiple properties. Because once you're partway into it and you say, gee, I didn't think of this question, then you've got somebody you can call and we'll answer that one. Because when you're doing 40, 60, 80% of it, and you call me with the tricky question, hopefully I've seen it before. I've seen many of them. I won't claim that I've seen them all. JJ, 1031 exchanges in 10 seconds or less. How'd I do?
Fantastic. Absolutely fantastic. Absolutely. Go ahead.
I want your folks to have confidence. And there's a lot of misinformation on the internet about 1031 and what it's all about. Last year or two, I found myself answering more questions about what somebody read.
Yeah.
And somebody wrote an article or posted some interpretation, and they missed something because it's not what they do all the time. So be careful with what you read and fall back on the essential elements. They're a good framework.
Bring on Mark. Mark Presswood, you're on with John Mangham. What is your question, Mark?
Hello, everybody. Thank you for all the information today, John and JJ, for putting this stuff together. What are the most common mistakes that you see people doing with 1031 exchanges?
Good question. A week before a closing, I get a call and somebody says, I talked to my CPA and he says I ought to do a 1031. The mistake they made was not starting 2 months ago because they've only got 45 plus maybe 5 days to closing to shop for replacement property. That's one common mistake. Another common mistake is what I just alluded to, where you call your real estate agent and say, show me everything from 800 and up, and you miss the good deal right below the threshold. Shopping early, look below the range. Some people don't have a grasp of what like kind is, that's broad and you can buy different kinds of properties. Some people forget that they could buy multiple properties. Well, I've got 800 to work with, and I really want this 350 and this 350, and I've only got 100 left. What should I do? I don't know. Are there some vacant lots that might be interesting to hold on to? Oh, I didn't think about vacant lots. Like kind, investment property. So I see those things. Starting the dialogue early is probably the most important thing to do. And I don't want to admonish people for making a mistake. I just want to say, don't get caught starting late. Start early. Call me sooner. And if we don't actually do business for 2 months because you're marketing and selling your property, that's fine. When you're ready, we'll be ready. Let me expand on that point. People don't understand that for the 1031 exchange to work, and JJ, we haven't talked about this because I always fail to tell people a little bit about my role. The role of the qualified intermediary, the facilitator who serves to get you from the one you're selling to the one you're buying and puts documentation packages in place at both closings and connects the two with a designation letter, the target ID letter. You need to engage the facilitator, the qualified intermediary, before you get to closing. The single worst mistake, and this is the one that I just, it kills me, because as much as I want to say yes to everything, I get a call, Mark, and you call me on Thursday and you say, John, I closed on the sale yesterday, but I haven't put the check in the bank yet. What do I do? If you didn't get the 1031 exchange set up, paperwork set up prior to closing, you put the check in the bank and you pay the taxes. There's not a darn thing I can do for you. Call me the day before closing, call me a week before closing, call me a month before closing, but you need to have your intermediary, which is what we do. I've been serving as an intermediary since 1988. Hard to believe I'm that old. You need your intermediary engaged prior to closing. Informally, for the consultation / strategy call, a month before or whenever. Formally, 10 days, 2 weeks, or when you go under contract. So if you're selling, you put a property on the market a month ago, you got a contract today, the buyer who's buying it from you has a due diligence period of 7, 10, 15 days. As you're approaching the end of due diligence and the deal looks solid, that's the time when I'll ask for a copy of the contract. I'll send you our seller profile form to fill out information on who the selling entity is. That's when we'll get into gear formally. That's when you engage us. And we'll start coordinating with the closing firm to get our documents in place with them. So again, the fatal mistake is leaving closing with the check in your hand, because you can't unring that bell.
Mark, did that answer your question?
Absolutely. It just raised another question. Is like we were going through a scenario where they had a quick close, no inspection contingency and all the things, and it was, super fast, all cash, and we ended up having to extend, but that extension went out some time. So it would have been a mess to actually identify a property, like, because we had no idea when the thing was really going to close, because we were riding an extension. So it's we're under contract, but the contract ran 90 days till it closed with the extensions and everything. So I guess it's once the money's changed hands, basically.
Well, once it's
Yeah.
closed. So if
Yeah,
you're under
once it's closed.
contract
Yeah.
and you think you're closing next week,
Yeah,
and you're out shopping, you're identifying property, you're perusing the market, you're even making offers.
absolutely.
Then you come home and you get the call, and your buyer said, I'm going to extend for 30 days or 60 days or whatever.
Yes.
You got to pull back. The hard part of this, the nuance that you don't see or feel until you've been in a transaction, you're managing two transactions at virtually the same time. The one you're selling and the one you're trying to purchase. And you're trying to negotiate to purchase something, so you get them lined up. The IRS would like nothing better than for you to trip and fall, fail to purchase, because they're going to get the taxes.
Yep.
And you'll fail if you write a contract for the replacement, you get an extension on yours, and that buyer forces it, or they give you whatever they give you that you've agreed to, and now you can't go acquire your replacement. So it's a delicate balance. It's a delicate balance. I see this with commercial properties a lot, where people are dealing in multi-millions, and contracts have multiple extension clauses in there. How do you know when you can start making offers on the new property? It's not easy. The IRS doesn't make it easy. I simplify it so that you get it conceptually, but the reality is the market logistics, the dynamics of the transaction, the negotiations with you, the seller, on the front end, and you, the buyer, on the back end, all that's happening at the same time. And if you're not outside the department store at 4 o'clock in the morning the day after Thanksgiving, there are 200 people there in front of you. Yeah. And there are only 100 of the hot sale item in there. You're not going to get one. So be alert, be boots on the ground, and be looking at multiple potential replacements. Don't get all emotionally hung up on one deal. Lots of deals are out there. There's another good one. So I wish I could give you that there's a magic bullet for this. People ask me about extensions. Oh, I had this property under contract. It fell apart. The inspection went bad. How do I get an extension? There are no programmed extensions in the world of 1031 exchanges. Occasionally, a taxpayer will get an extension because there has been a presidentially declared disaster, like the fires that came through California, like tornadoes that come across the Midwest, like hurricanes that come across the South. But for there to be an extension, what happens is there's a casualty. The president of the United States must direct the Internal Revenue Service to grant an extension to timed events. Timed events like the filing of quarterly estimated taxes, the filing of your individual tax return, the filing of quarterly estimated payments. And lo and behold, the target ID and the completion date for a 1031 exchange, because they are timed, they get an extension. Extensions are not granted for the 1031. Extensions are granted broadly for timed events, and they are granted by county. There are a little over 3,000 counties in the United States. And so when South Georgia got hit by tornadoes, the IRS pronouncement that comes out names the counties. And so if you had a property you were selling in one of those counties, you got an extension whether your property was damaged or not. If you were buying and negotiating on a replacement property in one of those counties, you got an extension. But you do not ever, ever go into a 1031 exchange hoping for a disaster. Because if the disaster happens on your property, you got a way more bigger issue than just getting a few more days on your identification or your acquisition. So while there are extensions granted, it's for timed events, not for 1031s. 1031 falls under it by virtue of the fact that it is a timed activity.
I had a little follow-up on that, and I think I understand it. But if you have a property and you're even thinking about selling this thing, you're even thinking about doing a 1031, it's probably better to start looking in advance, right? Get an idea what the market looks like.
JJ, my most sophisticated clients don't put property on the market. They shop for good deals. And they shop carefully and they wait and they wait. And when they find a good deal, they go get it tied up. If they can get a 90 or 120-day close on it to buy it, that's great. Then they open their deck of cards because they've got multiple cards, right? They got multiple properties and they say, I think I'm going to get rid of this one. Actually, let me pull a different thread. For those of y'all that are getting started, you're working on your first or second or third deal, that's good. You got to get in the game. For those of you that have been in this business for a little while, I would argue that there's an exercise you should go through every year. 30 seconds. You like my 10-second elevator speech? Here's your 30-second annual review exercise. List your properties and take no more than 30 seconds. Grade them, A, B, or C. What's an A? Well, it's good cash flow. It's a pretty property. It's a condo at the beach. I get good rent on it. An A makes you smile. That's easy. What's a B? I'm not sure. Fine, set it aside. What's a C? If an A makes you smile, a C makes you frown. I have continued repairs. It's on the other side of town, and I moved to a different part of town, and now it's too far away. It's a pain every time I have to go to it. Invariably, I got to go during traffic. It's a mess. It's a distraction. The school district shifted, and my tenants aren't as good. It seemed like a good deal, but it's turned out to be not such a good deal. That's a C property. At the end of the year, if you'll take your properties 1 through 5, 1 through 10, and grade them A, B, and C, you keep the A's, you keep the B's because it's not clear. You got 1 or 2 C's, those are your get rid of properties.
Mm-hmm.
You don't get rid of them, JJ, until you know what you're going to buy. You start with the end in mind, and you go find yourself another A, or at least an A minus, or even a B plus. And when you found the new one, then you get ready and you bring your C grade properties to the market.
Mm-hmm.
And you do a 1031 exchange.
Unbelievable. I'm loving you right now, brother. I've got, a number of shopping centers, and I've got a couple of them that are C properties. And I would love nothing more than to drop these things like a ton of bricks and move them into something else. And I'm going to start shopping.
So, JJ, you probably know some people who would buy those C grade shopping centers.
Oh, yeah.
And if you have a little dialogue with them, what I find in the world of 1031, the property I'm leaving behind that's a C grade that I'm just tired of, I don't have to make the last 10,000, 25, 50,000 on the million or whatever the number is. I need to focus on what's going to get me further down the road. And I'm not prepared to go do the big extensive rehab or renovation on the old property. I don't sweat the last few dollars if I've got a buyer who says, I'll buy it from you, JJ. You give me 60, 90 days heads up. I'll get my financing. I'll buy your shopping center for $1 million. You thought it was worth 1.1? Yeah, maybe 1,050,000. You got a buyer for $1 million? Look at yourself in the mirror and say, you know what? Realistically, that's probably a fair or fair enough price. And if I can take that million and deploy it strategically into one or several replacement properties, that for my stage in life, because I'm a little older, I want a little easier. I want a little less management. I want a little less renovation. I want a little newer condition. If I can deploy it into those properties that will continue to appreciate, and I save all those taxes, I get rid of headaches. I get rid of driving across town. I get rid of a C property, which is your annual review exercise. It takes 60 seconds. I like the short and sweet because once you have a grip on that topic, you can dig into it as much as you want. You get rid of the C grade property. You get that buyer out there to work with you. And who knows, he may be doing a 1031. He says, JJ, I've got 45 and 180 days. You're nodding your head like, yeah, I know about that. He said, if I can identify your property, I'll close on it in 4 months. I'm good with that. Now you're working with your buyer because he's doing a 1031 to buy your property.
Yeah.
And he's ready to renovate the whole thing. Now you're going to go out and shop for replacements. You might find it in 2 weeks. You might find it in 6 weeks. You still have to go find it because you're going to sell that C grade shopping center. But when you find it, you call your guy and you say, I've got what I want. I've negotiated a price. Let's work towards a closing in 40, 50, 60 days. And now we're all in this together. And you know who's not getting the money in the deal?
Uncle
The
Sam.
Internal Revenue Service.
Yeah. Now let me ask you. So if I'm going to do something like this, and one of my properties, my tenant wants to buy the property, another property, the guy next door owns the next 3 buildings. He wants to buy the property. So I basically got my 2 buyers, lined up. Now, if I'm going to do the 1031, I still need to, I mean, if I want to be smart about it, I probably need to engage someone like yourself, right, to come in and handle this and coordinate this and
Yep. So you've already identified your buyers. You got to tweak and negotiate a little and nudge and push and get them to the price that everybody can get happy with. That in your heart of hearts, the price is probably fair. You're not dealing with an unknowledgeable buyer. Your tenant already knows the condition. The guy who owns the other buildings knows the values. You get to the price and you say, I'll take this price, but I've got to go find replacement property. JJ, for you to structure your 1031 exchange, once you've got the contract to sell the shopping center, you're going to call us and say, John, will you be my intermediary? Absolutely. I do this all over the country. I've done them in California. I've done them in Alaska, Hawaii, and New York, everywhere. So this is federal tax law. So we'll be your intermediary. Our fee for a typical exchange is going to run $1,000 to $1,500. We're going to put the funds in a qualified escrow account. The clock's going to start running, and you will have potentially already gotten contracts on the replacement. 3, 4, 5, 6, 8 weeks later, you're going to be calling saying, I'm ready to close on my replacement. And you're going to sign the authorization to wire the funds out of this account into the purchase of the replacement property.
wow.
So yes, I'd love to be. I'd love for you to be another one of my success stories. I don't ever name my clients.
Looking forward to it.
They're welcome to name themselves, of course. A lot of the stories I tell, they're all quote hypotheticals, but these are real clients. You'd never find them. You don't know where the property was, but some of them have had some amazing stories and amazingly effective transactions. So the collateral benefit I get for being in this business, I hear about people's real estate stories. I hear people who are successful. It helps me be more successful with my little basket of rental houses. And you can bet I've done a few 1031 exchanges in my time.
Yeah, you have, brother. You've been absolutely amazing. You've dropped a ton of knowledge. We have a couple more questions up. I think we'll take those after we close the call. We'll have an open forum, maybe address those other questions. I've got 2 last questions for you before we kind of close up the recording here.
Okay.
One, and then we touched on it a little bit earlier. If people are watching on YouTube weeks and months down the line and they want to connect with you about questions, how to engage your service, what's the best way to reach you? Would it be your MySpace page or TikTok?
JJ, I wish I had a different social presence, but I work in a world where I'm going to be holding your money in an escrow account. You're going to be talking to me about your business, your financial position. And so I want people to find me, but once you engage me, our dialogue is very private. So I'm findable. My company is Craft 1031 Solutions. My email is johnmangham@craft1031.com. You've got a copy of my brochure, and I'd love for you to share that with all the folks on the call. My partner Diane is in South Florida. She and I have been in the same business at a previous company for almost 30 years. And we're now in business together in Craft 1031. Generally, JJ, I find that people are interested in this. They like hearing about saving taxes, but they don't need me until they need me.
Yeah.
And they need me when there's a transaction. So 2 weeks from now, you're going to have a thought. Hey, I've got this rental house and I'm selling this shopping center. Shopping center's $1 million. The rental house is 500. Can I combine them? We didn't talk about that. Actually, yes, you can. You start two separate exchanges, two separate sales, two separate target ID periods, and then you take the 1.5 million and you can roll it into one replacement property. Absolutely. So when you have the question about the transaction, that's really when you need me. When you want to pick my brain about strategy, logistics, the rules, all the questions, fees. We didn't discuss a reverse exchange, and we're not going to go deep into that right now. But the call comes in. I'm shopping, I'm perusing the market, and I found a killer deal. Can I buy the replacement before I've sold or relinquished? And the answer is yes. It takes financial strength. It's more expensive.
Yeah.
But if it's a killer deal, we absolutely do it.
Mm-hmm.
So I'll just plant that seed. There's some information about reverses on the website, and I can talk further about it if you find yourself either going down that path or in that position. So I can help, but generally people don't engage with the details of the transaction till they're virtually in the transaction.
And ideally not before it's too late. One of my favorite sayings is better to check in on something before you need it than you don't check into it and it's too late.
Exactly right. Thank you. Yes.
Now, I got one last question for you. And we've kind of touched on it a bit. I always talk about networking, the importance of visibility, building your network before you need it. There's so many people, so many education groups that have a Facebook page for their community. People coming to social media every single day for real estate investment. Some with no experience, some with a great deal of experience, but they're now using social media for the first time to build their business. How important is it for the real estate investor of today, whether they're brand new or very experienced? How important is it today for the real estate investor to utilize social media to build their business?
So, JJ, I touch on social media. I'm going to just say lightly. I'm going to say using social media is important, but just as if you go to a networking session and you meet people in person, you want to get a feel for who they are and whether you want to do business with them, go into social media carefully. Share a little bit of information, get a little bit of information. Check and see who else is talking to these people that you're talking to. There are sharks out there. There are sharks everywhere. So don't believe that just because somebody on social media is telling you, it's a pot of gold at the end of the rainbow. There's hard work in this.
Yeah.
Use social media to get yourself out there and get some education, and then validate some of that with some in-person meetings and go to different websites. And if you're hearing the same thing in different places, it's probably correct. But if somebody's promising something that is a little too good to be true, well, you know how the saying goes. So
Yeah.
social media will get you more education faster than the old days where we all went to the RIA meetings because that's all there was. But be diligent when you're using social media to be sure what you're getting from it is quality.
Exactly. The thing I talk about all the time is screen those you're dealing with. Ask for their references. See what the resume looks like. Talk to people they've worked with. Don't take everything verbatim. And, for you guys listening right now, whether you're on the call, whether you're on YouTube, check people out. Trust absolutely no one when it comes to business. You know, References, screen people, Make sure if you're using Facebook, for example, make sure you know the people you're adding. Get their phone number, talk to them, get a feel for people. And if you get a bad feel for someone, you're probably right. So, John, thank you so much for today. Hey, if you guys are watching on YouTube right now, you've enjoyed John's interview. Please like the video on YouTube. Please put your takeaways in the comment section, what you really found informative, what you really liked. If there's something that I can do to bring you better product, a better video, better interview, someone you want to see, please put that into the comments. We really appreciate what you feel, what your perspectives are. Again, if you'd like to connect with John, um, go to his website. It's Craft 1031 Solutions, and the email address is craft1031.com. And again, John Mangham, his partner Diane Rivera, they've been doing this for a minute. They know what they're doing. These are the people to contact. If you guys want to connect with me, you want to join my networking group, scan the turquoise QR code here. Takes you to my website, jjazizian.com, and hit the register now button. And please register for my group. If you'd like to see more of our interviews on our YouTube channel and go to the YouTube channel, scan the purple QR code, go to Flipside Up with JJ on YouTube and subscribe to our group. Really appreciate you guys. If you guys are on the call right now, don't go away. We'll take a couple more questions. But for today, just want to thank everybody. John, thank you so much. Can't wait to see you out here in Los Angeles next month. And for everybody else that's watching on YouTube, we'll see them in the world of virtual networking, and they'll contact you through your website.
JJ, thanks for having me on the call today. I've enjoyed it, and I look forward to seeing you in person.
There you go. Guys, thanks for joining us. See you soon.